From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. This is Tony Fratto at Hamilton Place Strategies. This is the HPS Macrocast. It's Friday, November 22nd. I'm here in our DC offices, back in the studio, which is always great, with John Fagan and Brendan Walsh from Markets Policy Partners. And I don't know, is it? It's not Groundhog Day. It's we have the daily ups and downs of whether a phase one, a U.S.-China trade agreement of some kind is going to happen. I'm on record as being skeptical that it's actually going to get done, but I'll say that in the 6-day intervals in between our Macrocast recordings, I sometimes you have moments of optimism also. I think today, a president out saying we're close again. We saw he always says we're close.
So I'd be curious on your thinking.
Yeah.
So the kind of the lens that I've been looking at it through is very, very simple. I think that the president is in re-election mode. This China thing is not helping, so he'd just like to get it done. But that also assumes that China is ready to make a deal. So I'd be curious kind of your thinking on it.
Yeah, I think they do kind of need to get it done. They need to get something done. I don't think to me, like, calling it phase one is like calling, Mel Brooks's History of the World Part 1 is, there was never a Part 2. I don't think there's going to be a phase 2 to U.S.-China debate. So it's the thing. And so is the thing going to be sufficient that the president can go out and say that this is the most beautiful, luxurious trade agreement ever negotiated? I think the reason for a phase one is because they know that it's probably not going to hit that mark. It's going to disappoint on some of the structural elements, and the Chinese have made it very, very clear that there is that they are buying tariff relief for their commitments on agriculture purchases.
That's a really important point,
right? That's the trade-off.
Yep.
Which again, like, it's weird because the Chinese used to buy a lot. They stopped buying some.
Yeah.
We used to not have such high tariffs. We increased our tariffs. Now we're going to like sort of pre-war conditions to a degree, and so you have to wonder, what was this all for?
Yeah.
But I think you have the politics right. I think like the idea that they were going to put slap tariffs on consumer goods. And people are thinking, well, we'll slap consumer goods on these things that we're all going to buy right before Christmas time. It's like, well, but we don't buy them right before Christmas time. They've all been purchased already. In fact, we've seen some of the front loading on inventories.
That's a really good point.
Yeah, it's like all that stuff is bought already, but it's not a great signal, and it would be a bad way to end the year. And
that could be a little bit drag on the first half of the year growth, because people bought inventories looking ahead, so they don't actually have to buy them.
Right, and that's some of the distortions that the trade negotiations are having.
Exactly,
and that's one of them. But there's also some opportunity for political distortion, and the political distortion is you don't want this stuff hanging out there when you're being impeached. You're trying to get the U.S., Mexico, Canada free trade agreement. You're not sure what the economy is going to be, and especially if you are worried about this, of a potential, first quarter slowdown, when people are starting to make up their minds about what they think about the world and the economy in the first quarter in an election season. So I think everyone would like to get it done. I think the Chinese are tired of it.
Yep.
Also, I think that's some of what we've seen from Liu He and Xi and their comments. And so, look, I think something is going to get done.
And the Chinese economy has been weak. We saw them be a little stimulative this week, too. So, I think everyone just wants it done with.
So it's not as exhausting as Brexit, but it's pretty exhausting.
Yeah, the markets just keep dancing to the tune of the latest headline. That headline chasing, it's just led to
It's really amazing.
Just how sensitive it is. Whether it's real, it is. But like the markets are definitely.
It's real. When you overlay, comments that things got worse, the market goes down, and then when the comments that get better, the markets goes back up.
Yeah, it's easy to feel a little bit chagrined, the fact that the big, deep, strong S&P 500 is running willy-nilly on these just the latest.
But it does.
But it does.
Yeah.
That's exactly what it does. And it's hard because we're dealing with such consequential, the expectations built into the market were less than 1% below all-time highs, which we put in on Monday on the S&P 500. Yep. So it's not as though there's a real fear factor here built into the markets.
No, but the companies that are being broadly owned that you're invested in, people are invested in, are big globally active companies.
So it kind of sounds silly, but if you take a step back, it actually is rational. Yeah. If you think that this trade war could drive us into a recession, you don't want to own stocks. If you think it's going to end and the economy is doing good, you own stocks.
Right, yeah. The expectation that we have some sort of really big breakdown in this phase one. I mean, the stakes are actually really pretty high for this phase one deal. Yep. This was supposed to be the layup. If they can't get something done, we've seen, successive breakdowns. Now, if this is an 11th hour failure, another face plant, this is now a pattern, and the understanding is if they can't get this phase one done, they can't get anything done, and now we're really in the weeds. And so that's another part of aspect of this trading dynamic which we see, which is it's really hard for investors in their trading strategies to account for low probability but super high risk. Issues like this.
Right.
Yeah, that's a great point.
Yeah. So, so if you were advising them, tell them where are you today on telling them what to expect?
Yeah, my expectation, and I think Brendan and I have been in accord on this, is that a phase one deal of some variety gets inked, and it probably, at this point, spills into early next year. The Trump administration is happy to put off the December 15th tariffs instead of putting them on as a show of good faith in terms of keeping the dialogue going, and then sometime early next year you come up with a relatively modest agreement that is, as you say, sold as the most luxurious and delightful and
beautiful.
Yeah, and they have to find a place to sign it. Just logistically, he's not going to allow this not to have pomp and circumstance around it.
That's going to need an event of some kind, for sure.
But the degree of rollback, maybe the U.S. there are indications that we saw this week that the U.S. was maybe willing to play ball with some potential partial rollback of already existing. That would be a net positive rather than just a sort of a confirmation of where the markets already are.
Yeah, so would you agree that I don't think the Chinese are going to sign a deal unless there's some rollback.
No question about it.
If it's not, it's just like, we're done.
Yeah, I think, and look, I mean, smart people that I like to get their sense of what's going to happen. The consensus is that there's an opportunity to roll back the tariffs that were put on back in September.
Yep.
That makes sense to me. But again, like it's gonna. The problem is that the things that matter are the structural reforms. Mm-hmm. It's hard to be very ambitious on the structural reforms because what you're pocketing are promises. And so promises for the future don't, they're just really hard to quantify. Yeah. So if you got this metric over there of like, dollars for tariffs, those are numbers. Mm-hmm. You can do the trade-off real easy. But the things that matter are structural, IP protection, no forced, joint ventures, those kinds of things.
And even if China wanted to do it, these are things that just take time to implement. It's not going to happen overnight.
An example is one of the structural reforms they're already doing. They promised to do for a long time. They're already doing. This is the opening of the financial sector. Yep. The opening of the financial sector is going to be one of the things that is in this agreement. Just kind of silly because it's already.
Yeah.
Not only is it,
and China's doing it for their own best interest.
They're doing it for their own best interest, and it's happening already. But they're going to say,
throw it in.
They're going to throw that in. They're going to throw in currency, no currency manipulated, and reporting on if you're intervening. And so like, what does that mean? Because the way that the Chinese they haven't been intervening to weaken. They've only been intervening to strengthen or slow down the weakening of the renminbi, but they don't necessarily do it by central bank operations. There are lots of ways that they can get into dollar markets to impact the value of the currency. So So how they prove that, how you show it, how you talk about it publicly is a really complex, difficult thing. But they'll agree to some commitment to not intervene to gain an unfair trade advantage. They will say that we can, have operations for monetary policy reasons, just like the U.S. Federal Reserve and the ECB and others do, Of course, right? Which is like the whole conundrum with all of this. And
on Christmas, my wife wraps things I've already bought for myself and gives it to me. It kind of feels like
pretty good. That's what that would be. It'll be something like that. Yeah, but you know what you're getting, and pretty exciting.
Just a last point, we saw this week some heartburn among investors that the Hong Kong's pro-democracy bill that passed Congress resoundingly and is now going to the president's desk will sour the mood, basically. And the Chinese have threatened, obviously, unspecified retaliation. But we've seen in the past, the expectation is that the president is going to sign that bill, but that he will continue to compartmentalize the issues in Hong Kong from the broader trade negotiation. And it doesn't look as though the Chinese are eager to conflate the two.
No, I don't. They're not eager to conflate the two, and there are other things that they compartmentalize also, and so I think they're happy to they're not happy about the bill. They're happy that it's not what some of the earlier versions.
What was the politics behind McConnell finally putting it to a vote?
That it would not disrupt trade negotiations. So getting some understanding that the Chinese aren't going to blow up the trade discussions, I think allowed the Senate to move forward.
Yeah, I kind of view that as a bullish indicator because there's no way they would have taken it on to the floor if it was going to screw everything up.
Yeah, I think that's right. So more news. We'll see. We'll see what happens in the next episode.
But you're still cautious.
I'm cautious because I think it is hard. I think it is easy to screw up. I mean, there's one thing that I keep in mind here is that so you can have those elements thrown in. I think they are having a much harder time. It should be done already. In fact, actually, 2 months ago, it's done. Right? They said it's done. They just have to go ink the paper.
Yeah.
That's what they said 6 weeks ago. Right? And we're still
no new things are going to be thrown into this thing.
No,
we know what it is.
But the math on this, but especially on the ag purchases, it's just. There's something that's disingenuous about it is they're throwing around really, really big numbers that, as I keep saying, we can only grow so much stuff in a certain period of time. It has, by the way, that has huge other, unintended consequences. If the Chinese say, we'll buy, our commitment is we're going to buy this much pork or sorghum and soybeans. Well, we have to produce it. Yeah. That means we have to stop producing the other things that we're growing on that ground. Whatever it is, corn, wheat, I don't know. But whatever it is
doesn't happen
doing,
overnight.
There's only so much farmland we have, and so we have to go do that, and it takes time to do that. China can't eat more.
No.
Right? I mean, they have a problem. They do have a supply problem on pork, right? And that they need actual pork, right? But the reason they were buying, they're buying feed crops to feed pigs that they no longer have,
exactly,
because half of the pig population isn't alive anymore, right? They had to kill the swine flu. So
and that's why they need the soy for the feed to the pigs.
They were feeding pigs with it, and so
there's no way they could buy $50 billion worth of soy.
What are they going to do with it? I mean, you can only
and it goes bad. It's not like you can put it for 10 years from now.
Every edamame for everyone. I mean, there's just not. It's really hard to consume that much unless you are feeding it to pigs, and they don't have the pigs anymore. So it's just it's hard. It's much more complicated than. I think the White House keep throwing around this number. Oh, they're going to buy all this, all this ag product. And it's not that simple. It's really hard to do. And then buy it for what? What is the trade-off going to be? As we have said here many, many times, that trade agreements, regardless of what the president says, trade agreements need to be win-win. Mm-hmm. So they need a win. And unless you start identifying their wins, and the only wins that they can take at this point are because we're not going to give them more market access, we're not going to relieve export controls, and we're not going to let them do more investment in the United States. So the only thing left are the tariffs, and so he's going to have to roll back the tariffs. So that's why I get skeptical, because like some of these things are hard. It's going to be hard to be very ambitious, but. As long as they can weather that whatever the deal is, even if it's not very ambitious, and he's going to go out and call it the greatest trade agreement ever, and if they're okay with that, then they'll get something done. But I do think it's going to be not the pretty light on actual real benefits for the bilateral trade relationship.
Yeah, I totally agree.
Why don't we take a break there, and we'll come back with we got some good Fed news this past week, minutes and other fun times with the chairman going to the White House, which doesn't happen every week. So we'll get into that after the break. You're listening to the HPS Macrocast.
Hamilton Place Strategies is an analytical public affairs firm based in Washington, D.C. Learn more at hamiltonplacestrategies.com or follow us on Twitter at HPS Insight.
We're back on the HPS Macrocast. We had Chairman Powell go to the White House for a meeting. It was weird as a communicator, somebody who was communicating at the White House and with the Fed from time to time. It was weird that the news of it came out from a Fed statement.
Yep.
Not anyone at the White House telling reporters that this meeting took place. It was Powell and the president and Treasury Secretary Mnuchin. Was there anyone else there? Or was it just? I think only those three is what I recall. So in any other time, any other administration where the president of the United States is not going out on Twitter every day calling you a bonehead and other assorted names, this would and ought to be a benign event. I actually still think it is kind of there's nothing wrong with, and I'm a strong defender of Fed central bank independence. There is nothing wrong with the chairman of the Fed going and having a discussion with the president and his top economic advisors, right, to talk about where they see the economy and how things are going. And even with the noise of Trump always abusing him on Twitter and anywhere else he gets a chance, that there's nothing wrong with it. I mean, but what did we learn from it? Anything, John, that makes we should be thinking about?
Yeah, the president tweeted that it was a good and cordial meeting. No
that was his first tweet.
It was right. He expressed his opinions. He's very consistent on the point that interest rates should be lower and that the Fed was really dragging their feet, and interest rates should be negative. Other countries are being paid to take on debt, in Germany, so forth, and the U.S. We ought to have that here. Well, obviously the Fed doesn't agree. But the Fed has come a very long way. One of the biggest macro themes of this year, alongside the U.S.-China trade issue, really is the Fed's pirouette. At this time last year, the Fed was in tightening mode and was locked in on tightening. It was the terminology was autopilot. It was a little over a year ago that Chairman Powell employed that phrase, and it received a significant amount of market blowback for that. That was then. This is now. The Fed has since basically performed a very swift retreat from their tightening cycle, and has cut rates in 3 consecutive meetings. The last rate cut was in October, and they're signaling a cautious pause, but this is a very cautious sounding pause. Expectations for a 4th consecutive rate cut, as reflected in the futures markets, are basically nil. But when you look out into 2020, the futures markets are pricing in more cuts.
That's amazing.
It's a greater than 50% chance, as currently reflected in the markets, for a cut by the middle of the year. And within a year from now, the market is pricing in almost 2 full 25 basis point rate cuts, which would basically bring us down to 1%.
Amazing.
That is not a vote of confidence in the reflation trade, in the the narrative of a global synchronized recovery in 2020.
Do you think is this because people expect underperformance on both on growth, on output, and on the inflation target, or are they is this a clue that they're getting from where the Fed intends to take us?
I think there's almost uniform agreement that the inflation target will remain a very big challenge to hit. And they're certainly the Fed has under Chair Powell, they've narrowed their focus onto core PCE, personal consumption expenditure prices.
We get that reading next week. So, but core is at 1.7%, and it's been coming down. We were at 1.8 earlier, a couple months ago. And there's no indication that it's going to go back up. We'll probably stay at that 1.6, 1.7.
Lael Brainerd was interviewed on CNBC, and her view on this was like, look, I mean, we did three policy rate cuts. It takes time for them to have their impact, which I think is, that's
totally valid.
Fair,
Absolutely right.
But I think it's probably more fears about growth. And actually, you made a really interesting point yesterday about the initial jobless claims. Maybe the market's sniffing out what you're looking at.
Maybe, I don't know. That was this is something we were going to try to do some research on and would like to do more. And I'm fascinated by weekly jobless claims.
I 100%
come out every
that's my most
Thursday.
Important indicator of the economy.
Do you feel like people don't pay enough attention to
I'd say,
it?
well, they've also been at so low. They've been at 215 for 5 years now. So I think people are just
and there are like some structural reasons for why they've gotten so low. But they're outrageously around. I remember it wasn't not only not troubling, just like normal to have, if the economy could be going really, really well, and you could have something in the 285 to 300,000.
That's very normal.
Claims. Very normal, right? And that would have not concerned anyone. They've been down near 200,000 a week for a really long time. And what we saw in the last couple of weeks, and we'll look more, but like they have missed expectations where so weekly claims have grown. They've been slightly higher than
it's been 10 to 15,000 higher than expectations.
And higher than past readings. And so
basically every time we go into recession, initial claims spike
that's
before.
Sort of where
it's
it starts.
It's
like a canary in the coal
and
mine.
it's totally logical because this is actually a check that the government sends to people because you're unemployed. This is
there's no modeling.
No.
It's people they're filing for for the first time.
Yes,
they're filing for unemployment benefits, and so it's an official act, and there's no guessing around.
Yeah,
right.
It does get revised, but it's by like 1,000. So the revisions
really
are de minimis.
And we saw over the past couple of weeks, we saw market participants. The equity market has been pretty sold on the idea of an economic rebound. More or less, the equity market is reflective of brighter to stable economic outcomes in the coming quarters. But when you looked at the Treasury market, which had been sending a very downbeat signal, we talked a lot about over the summer. We talked a lot about the inversion of the yield curve, which is a classic recessionary signal, and so on and so forth. That has disinverted and it's steepened up. We've seen yields pop off the bottom. We've seen a real debate, certainly at the IMF and World Bank fall meetings. The big point of debate was the growth outlook. There was quite a big camp calling for a reflation, and it's easy to make that case because you have basically almost a year of major central bank stimulus in the pipeline now. You've got the trade war at least stabilizing, potentially even cooling off a little, like having some rollback. So it's easy to make the case that we're going to get a little bit of a lift. It's really hard to see in the data, though, and the data's just been muddy. We saw the purchasing managers indexes, the flash ones the preliminary ones come out for November overnight, and they were a real mixed bag. There was actually some stabilization in some of the manufacturing readings, but what we saw was a deterioration in services, which is not welcome. And so again, it's clear as mud, and the reflationary impulse that the Treasury market was beginning to kind of sniff out through October and earlier this month has come off a lot. That's faded to some extent. And the thing that to step back and look into 2020, the thing that is most concerning is if you have a situation in which trade really does get put into detente here, and you have all this central bank easing and monetary easing in the pipeline, and monetary settings at full, liquidity provision at full blast, and you still get growth rolling back over and deteriorating in 2020. Now that's a real problem.
Absolutely, and also more than one country it becomes a political problem as well. Certainly here.
And we heard Christine Lagarde, the newly minted president of the European Central Bank, coming in. It was her second major speech this morning that she gave, and she's calling for a major rethink in the policy mix to address the growth problems in Europe, and she's clearly referring to fiscal. So that is, good. Good
It'll
idea, but are the Germans really going to play along?
Well, we'll see, right? I mean, when Christine Lagarde was named head of the ECB, there was some made about the fact that she's not a central banker and she's not even an economist. Right? She's a lawyer and she has been a finance minister and then the head of the IMF. But clearly, I think what we've seen in Europe and seen it here as well, but it's clearly in Europe, is lots of activity on the monetary policy side. Central banks everywhere have been trying to do their normal things and extraordinary normal things in order to generate growth, but underperformance on the fiscal side. And so there is a question. Well, I mean, Super Mario Draghi could do a lot of things, but as not being a politician, not being someone who's worked in on that side of things, was he the right guy to persuade the Germans and anyone else that the fiscal side needs to do more? And maybe Christine Lagarde is that kind of person who can do it, because she does come from politics and she does come from, she knows what it's like to walk in those offices.
And he's Italian, so Italy's been a bit of a basket case, and fiscally also a bit of a basket case. She's coming from France, so I think she has a little higher ability to push the Germans.
That's a great point. Yeah, I mean, Germans definitely don't want those profligate Italians telling them what to do.
And just a last point on that. Obviously, we've seen the European Central Bank, the resident hawks, the Bundesbank, and the folks from Northern Europe coming out and militating against the Mario Draghi swan song easing, where he ramped up asset purchases again. And there's a lot of chatter, or increasing chatter in the U.S. about the Fed's balance sheet expansion. Obviously, President Trump had been pounding on the Fed to do quantitative easing.
He wants negative rates.
Quantitative easing. And we saw in middle of September, we talked about the liquidity stress in the funding markets and the response from the Fed. Obviously, the New York Fed and the Fed board provided liquidity, and the re-expansion of the Fed's balance sheet has been a story that's kind of flown under the radar, but not for a lot of investors. It has certainly behaved in some ways like QE4. It's the identical operation almost, but it's just for a different stated purpose. QE, quantitative easing, 1, 2, and 3 were specifically designed to boost asset prices.
Yeah.
That's what they are meant to do. It's what it says on the box.
Right.
That's why I think the meeting went so well. I think Powell explained to him, don't worry about rates. I'm buying all the treasuries.
Typical Trump fashion, though. Like he did. So he did have whether he didn't write that cordial meeting tweet, right? That was someone wrote the cordial meeting tweet. And then an hour later, we get to beating up the Fed again and saying how our lunch is being eaten by these other countries who will have negative rates, and we should have negative rates. We should have the lowest policy rates in the world. We're America after all. And it's like, what? Negative rates? No, you don't want to be the economies that have negative rates. Actually, was it any surprise looking at the Fed minutes
that they came out specifically and said negative rates are not
negative rates are not a good idea? Exactly. It's that's kind of random.
It's really hard to look at the impact of negative rates in Japan and Europe and say, "Oh, I want that."
I want to be just like them. It's really crazy.
No. Yeah. I mean, the Fed has literally never talked about it. So the fact that it's in the minutes is because of one person.
But sitting in the West Wing, he must be thinking this job owning is working. The Fed has come a million miles from where they were at this time last year.
Yeah.
And if I hadn't kept on them, they would be a lot slower. And I think that's actually, it's impossible to prove. But I think that there's a point there.
I think you're right.
Job owning does matter.
Yeah.
I think.
Let's take a break, our last break, and then we'll come back and take a look at next week. You're listening to the HPS Macrocast.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at HamiltonPlaceStrategies.com or on Twitter at HPS Insight.
All right, we're back on the Macrocast. John, Brendan, what do we have to look at next week? What's the data we have?
Yeah, it's kind of a mixed bag. Nothing monstrously market moving. We get some housing data in the U.S. And then over in Europe, we get a number of business climate and also consumer sentiment in Germany, in Europe, and also the U.K. And then in the U.S., we have the personal income and spending for October. And within that report, as we mentioned earlier, comes the PCE price index. And the core is what the Fed watches, and it's down to 1.7%. And the market's kind of looking for it to stay in that range. We also get third quarter U.S. corporate earning profits. So those are always very interesting.
Yeah. Durable goods are coming too.
And then durable goods on Friday. Yeah. Yep.
We need some data on turkey purchases. We usually get some average weight and cost. We're very bullish on stuffing going into this.
That's exactly it.
Are there any indicators? There's not. I mean, it is like I don't know. I mean, we're going to get actually what we are going to have. We have like Black Friday, and
it's a really big deal.
We're going to talk about Black Friday.
We'll tease that. That's coming up. But we saw retailers come out. Some major U.S. brick and mortar retailers come out with some really uneven third quarter results. For the most part, disappointing results from this sector is attributed to the structural problems in the sector. The competition, the trend toward online shopping. So it's not usually laid at the feet of a deteriorating U.S. consumer. Mm-hmm. But Black Friday numbers and Cyber Monday numbers are a different story.
Yeah, hopefully we'll be able to bring some discussion and analysis on.
Yeah, I think that's going to be a good one.
It'll be fun. All right. Well, have a great weekend. Tony Fratto for John Fagan and Brendan Walsh. This is the HPS Macrocast. We'll see you next week.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at HamiltonPlaceStrategies.com and follow Tony Fratto on Twitter at Tony Fratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.